What's happening, New Orleans? Check this out. Over the last week, we've seen another restaurant bite the dust. And this is continuously happening. Would you be surprised if I told you that there's about a 25 to 50% restaurant turnover in the city? So of the 1,500 restaurants, you got about 700 that's trying to grand opening, and then at the same time, there's like 700 that's grand closing. Now, the primary reason for that, in my experience, as I've talked to several restaurant owners, starts with something very simple, but it's often overlooked. It is how you actually measure your profitability and success in your business. And that profitability starts with plate costing. Let's walk through it. So what is plate cost? And how do we use plate cost to determine what our gross profit dollar should be and what our gross profit percent should be? And so an example here on the board, we have plate cost as being the sales minus the cost of all your ingredients. And so our example is that we sell an item for $10. We have ingredients that cost us $2.50. Therefore, our gross profit dollars is $7.50. And if you divide your gross profit dollars into your sales, you get a gross profit percent. Now, this is the ideal math that you want to have for your restaurant. Okay. So now you know how a plate cost work. The challenge is now, do you do this with paper and pencil, an Excel sheet? Who has the time? Click the link below. Click on our restaurant AI tool that allows you to scan the image, and it automatically begins to build out your costing for you, making costing recipes the most easiest thing you ever did. We just eliminated the headache that comes with costing out your plates. Now, the second part of business is determining your cost of goods sold. Now, while cost of goods sold is a accounting term, it is really the way that you determine how much you actually made in your operation, right? And so in our situation, we'll go to the basic formula, which is your beginning inventory plus your purchases minus your ending inventory is what gives you your actual cost of goods sold. Similar to what we did in the plate costing, sales minus your cost of goods sold, which is the aggregation of all your purchases. And by counting beginning and ending inventory, it captures all your waste throughout the period. Then you get your gross profit dollars. And like we did in the same example, gross profit dollars divided by sales give you your gross profit percent. Now, in this equation, we're going to say that we started with a $3,000 inventory. We spent $10,000 and we ended up counting $6,000 at the end of the day. Therefore, we had a total of $13,000 worth of inventory at some point. We basically said we sold off $7,000 of it. So now when we take and we say we did $20,000 in sales, minus that $7,000 of product that we got rid of or sold through, we left with $13,000 in gross profit. And then the 13 divided by your sale, your gross profit dollars divided by your sales give you a 65% gross profit. Now, if you think back to the example with the plate cost, you should identify quickly that we started with a 75% gross profit in plate cost, but when we did a cost of goods sold, we had 65%. That difference is waste. And if you don't first know what your plate cost is, secondly, do inventories, you'll never know that on $1 million a year that you're doing with 10% waste, you just threw away $100,000. Okay, now we've done cost of goods sold as well. You've seen how you determine plate cost, and now you get to see how cost of goods sold works. And many of us don't even take the time to do inventories. So it further complicates your capacity to really measure the true profitability of your business. That same link I told you earlier not only has a function to cost your recipe, but you can also use it easily to build out your entire menu and then also do your inventories. This way, you have one simple application that allows you to do your costing and inventory to manage your true profitability in one place. Okay, on our final example, we're going to talk to those folks who simply say, I use purchases as a proxy for my cost of goods sold. And what did that mean for their ability to measure their operations efficiency, as well as some of the flaws in it. Now, in this situation, we did the same $20,000 in sales. We're going to call it, we spent $5,000 this week. And then we wind up with gross profit of $15,000. And that's the math that a lot of people do. And so then when they work that through, they say, oh, wow, great. I got a 75% cost of goods. Hoorah. We get into week 2. We do the same $20,000 in sales. We spent $10,000. We wound up with $10,000 in gross profit. And now we're freaking out because now I have a 50% gross profit. And so what this does is not actually tell you your gross profit or whatnot. What it is measuring is your purchase to sales ratio. So in this situation, what you think is 75% gross profit, what this is really saying is that I spent 25% of what we did in sales and product this week. And then in this situation, it says I spent 50% of what I did in sales and purchases this week. So neither one of these give you true gross profit. And let's say that, for instance, you want to live in this space, or you're using this number, which is a good week, right, to determine how much you benchmark your profitability in your business, but you really have that 65%. You want to pay taxes on that 10% that should have been collected in waste. So not only did you not see the $100,000 in profit, you're now going to pay taxes on that $100,000 in profit because you failed to actually properly address waste, proper plate costing, and the proper cost of goods structure. Okay, now it should be extremely clear that you should never use your purchases to actually determine your profitability. It's simply a tool to allow you to see how much of your revenue that you spend this week, but not actually tell you how much gross profit you really made. And you can see clearly that this opportunity finds its way to your P&L, costing you thousands in unnecessary tax burden. This is the difference between just having an accountant and having a financial analyst who also has accounting tendencies. We actually can work with you from the plate cost and procedure to the cost of goods sold structure, and then really building out your P&L. Lastly, Culinary Analytics is designed to show you where the gaps in your operations are. You already did the hard work. You built beautiful, delicious tasting food. You brought people into a door and built a community around it. You owe it to yourself and your community to grow your business the most profitable way possible. No longer should you have to guess of what you're doing. You have one tool right here where you get your first recipe costed for free. And if you really want to dig in to how we do predictive modeling to really control what you're purchasing, how we do that to also predict what you're going to need in payroll, bringing all those pennies from your waste and overspending in labor to profit to your business. This is the Culinary Analytics Way.